Welcome to today's program titled Institutional Investor Insights, Avoiding Minefields in Limited Partnership Agreements. At this time, all participants are in a listen-only mode. For those of you who are logged into the web presentation, you are encouraged to submit questions throughout the conference by typing them into the Q&A box on the right-hand side of your screen. For those interested in obtaining CLE credit for this webinar, later in the presentation, we will read the CLE attendance verification code. Please write this code down as it will not be reread and is required on the CLE credit request form. During the program, you will see a slide with a QR code that you may scan to access and submit your request for CLE credit. You can also find a link to the form in the connection details email you received this morning. Copies of the webinar recording and materials will be distributed to all attendees in the days following the webinar. On the next slide, you will see a legal disclaimer. This presentation has been prepared by Seyfarth Shaw LLP for informational purposes only. The material discussed during this webinar should not be construed as legal advice or legal opinion on any specific facts or circumstances. The content is intended for general information purposes only, and you are urged to consult a lawyer concerning your own situation and any specific legal questions you may have. At this time, I would like to turn it over to our first speaker for today's program, Shamim. Shamim, please go ahead.
Hi, everybody. My name is Shamim Mohandisi. I'm an associate in the Seattle office of Seyfarth Shaw and a member of our institutional investor practice. I'm joined with my colleague Trevor, who will introduce himself now.
Hi, my name is Trevor Tullius, and I'm a partner in our institutional investor practice group in the DC office.
On the next slide, you'll see our agenda for today's webinar. We're going to cover preferred returns, management fee calculations, NAV facilities, and then we're going to work through all of those with some key takeaways before turning to Q&A. With that said, Trevor, maybe you can talk to us a little bit about preferred returns.
Sure. Thank you, Shamim. Next slide, please. So as we talk about preferred returns, we thought we would kind of quickly go through the standard waterfalls that you see in the typical fund. And here we're going to use, kind of partnership terms, LP, GP, et cetera. These apply in, in an LLC with members and managing members or a manager. But just for ease of reference through the day, we'll use LP terms and so that you can have the same frame of reference. So we just wanted to kind of quickly go through what a typical waterfall looks like. And so what we're seeing in fund terms, and I should also say when we say fund, we mean, private equity, real estate fund, credit fund, infrastructure fund. We're going to kind of use the phrase fund to be interchangeable and fungible today. So you've got those references. So anyway, in a typical fund, you would have either a European-style waterfall, which is a whole-of-fund waterfall, or a American-style waterfall. So in a European-style waterfall, step one is to return an investor's capital contributions. Step two is a payment of some sort of preferred return, usually expressed as a fixed percentage. There's a GP catch-up, which could either be 100% of all the dollars that come out or a percentage of those, which often equal the total percentage of the distributions there in steps 2 and 3, and then carried interest divided between the GP and the LPs. The difference, of course, in an American-style waterfall is it is a deal-by-deal distribution, and so each investment, as it is disposed of, gets those proceeds get run through the waterfall. We have this little note here about a hybrid waterfall. Essentially, we see these a lot in funds now where it is a deal-by-deal distribution, but there is a slight catch-up for expenses and or losses on prior realizations. So, again, a typical American-style waterfall looks just like a European-style waterfall, but deal by deal. And when we refer to a hybrid, it just includes catching up on expenses or other realized investments. Both of these features are going to have clawbacks often. Folks like to say if there's a clawback feature, then the end result of both models are the same, where LPs get the same, carry. But in reality, the clawback here, if there's a clawback at the end of the fund, that's generally a bad thing, right? Clawbacks essentially are money and is affected based on timing. And as you know, that also would be assumed or a net of an assumed tax rate. So that would be up to 40%. So if there is a clawback situation, it is different in a European-style waterfall versus American-style waterfall because of the time value of money. Their clawbacks are less likely in a European-style waterfall, even though they are possible, and much more likely in a typical American waterfall. Next slide, please. So just a quick couple of notes on preferred returns. Essentially, the principal feature of these is part of the contract where GPs are going to receive their management fee, but they also get the bulk of their compensation from profits on investments. And as you know, GPs have an information advantage. And so really what a preferred return does is it entices the manager to do some sort of minimal amount of work in order to have to get to their own returns. So that could be a double-edged sword. That could mean that it entices managers to exit investments quicker or delay an investment. But at the end of the day, it does require them to do something before they ever get a return. And consider maybe this as an example. If there's a fund that goes out and raises X in capital, and all that capital is deployed after, let's say, for example, 10 years, and then all of those portfolio investments are sold on year 10, and let's just say there is a 15% gain per year on those investments. Well, with a preferred return of 8%, the portfolio is going to have to return more than 200% of the original amount invested at an 8% compounded rate in order for the GP to ever get into the carry. So there is some incentive here for GPs to put money to work, generate returns, because they also want to make their money too, and they have to get past the prep to do that. Okay, next slide. So some key factors affecting returns that you should be looking at when you are reviewing these terms in an LPA, and that is timing. When does the calculation begin and end on the accrual of the preferred return? Base, what amount is the preferred return charged on, and whether or not it's compounding. So if you think about timing, usually the preferred return starts to run on capital contributions the moment that it is committed, it is sent to the fund. So it doesn't start when you have a capital call. It doesn't start when you send that in. It usually starts on the due date of the capital call. So that's something to consider. And then you should watch out here. There's going to be language on timing in other parts of the LPA. And one of those is if the GP makes a capital call for a contribution and then determines that it really doesn't need that money. Well, you're going to see language in other parts of the LPA, usually in the capital contribution section, that says we can return these amounts to you in a certain period of time, maybe 90 days, maybe sometime there's no time limit. And if we return those amounts to you, it is as though those amounts were never contributed. So it doesn't happen very often, but it is certainly possible that a GP can make a capital call for an investment. That investment doesn't happen. They turn around 60 days later, send that money back to you because they don't want to be carrying it, because if they're carrying it, it's earning the pref. And so you want to be sure that you take a look at those provisions to see if there's a time limit, what that time limit is. If there isn't one, you should be asking one. We often see between 60 and 90 days. So that's timing. Thinking about the base, so the preferred return is charged on capital contributions, but not profits. So it really does, you should be paying attention to, for example, defined terms of what a capital contribution is, what an unused capital contribution is. You should be thinking about, you know, what it is based on at all times, really. So think about, for example, recycled amounts. Well, you know, oftentimes the GP can use distributable profits for other purposes, but not all distributable profits. There's a profit factor in distributable amounts or distributable profits. So, you know, if they called $100 to make an investment and they've sold that investment for $300 5 years later, you know, the only thing you're earning a pref on for that time period is the $100 that was invested. If they decide to recycle those amounts or retain those amounts, we're looking in the LPA for a phrase that says, you know, these amounts will be deemed returned and recontributed. And we want to see that. Sometimes an LPA might say the GP can or may or can consider whether or not it wants to do that. But we're looking for hard language that says if we take a distributable amount and we don't give it back to you, but instead we recycle it, those amounts are going to be deemed returned and recontributed. Why? Because in that case, it would reduce the uncalled or unused capital contributions that are sitting with the investor, and the preferred return will start accruing on those extra amounts. And then compounding is just kind of a simple interest question, right? That's the calculation of preferred return using, you know, annual, quarterly, monthly, daily, or continuous compounding. We oftentimes see annual, but occasionally we'll see, you know, daily compounding. But that does affect, at the end of the day, the rates of compounding will affect the final numbers. Next slide. Oh, go ahead. Sorry, Shamim. Yeah.
As it relates to the timing of the preferred return accruing, what happens when a fund uses, you know, a subline to fund an investment?
Well, you know, that's a comment we make a lot, and our request has often been, if you are going to use debt to fund an investment, then that debt should be accruing the preferred return. And as a matter of fact, ILPA agrees with us, or we agree with ILPA, that if the fund is utilizing a subscription line of credit, the preferred return on those amounts should be calculated on the date the subscription line was drawn. Now, why is that? You know, some funds are going to argue, well, we're not actually using your money, which is why, and we'll talk about this later, they'll say, oh, well, we should be paid a management fee on subscription lines of credit. But at the end of the day, you know, our position is you have put our capital at risk, right? Because the subscription line of credit is secured by uncalled capital. So if the fund goes out, makes an investment on a subline, and that investment doesn't work out, you know, the bank is still going to come to investors for those amounts. So yes, good question. Our position and ILPA say, you know, if you're going to use a subline to make investments and in lieu of calling capital, then the pref should run when those are outlaid. Yeah. So just wanted to go through a couple of quick examples of what you should be looking for when you are going through the definitions of preferred return. And you know, there's a lot of moving pieces here, and as we discussed just a minute ago, there's going to be other provisions in an LPA that affect this. But essentially, you know, we've given some examples from some recent funds, and then ILPA's example. But if you look at the definition in a preferred return for a European fund, it's essentially here 8% annually, compounded annually. So there's our compounded interest question. And then what is it on? On a limited partner's unreturned contributions as determined from time to time, treating all distributions to you, the LP, as a return of contribution. So essentially that's easy because in a European waterfall, the first dollar that comes back is always returning your capital. So the base over time is being reduced here, but they're confirming here that every dollar that you get, every distribution you get is is a return of your capital contribution. And then they're gonna take, so these are when does it start? Contributions are taken into account on the date such contribution was due. So if it says it's due in 10 business days and you give it on day 9, there are, one additional day where that money is with the GP and it is not accruing a pref. If you give it on day 1, with the day you get the capital notice, then your money is going to be there for 2 weeks and not earning a preferred return. And of course, distributions are taken into account the day they are made to the LP. The pref here would continue to run on capital contributions regardless of whether the underlying investment has been sold until those amounts are returned to you. We've dropped ILPA's, ILPA's preferred language here too. It's very much the same as what we see. We kind of see across the board definitions here in European waterfalls. Next slide. So here we pulled essentially just the American hybrid definition because, again, an American definition, straight up American deal-by-deal waterfall is going to look a lot like a European definition, except it'll just say in accordance with the investment or the investment that's subject to a distribution. So here again, what is the preferred return is 8% per annum. It doesn't say here whether or not it is compounding. I'm sorry, it does right at the top. Annual compounding, internal rate of return, 8% over the aggregate contributions that you've made before the date to fund realized investment and cost contributions. So here, the preferred return stops running on that investment when it's realized, and it's running on cost contributions attributable to those investments. Let's just take a quick look at the next slide. Here, a realized investment is the date of any date of determination that the portfolio company that has been sold, is being disposed of, or written down or written off by the partnership, or distributed in kind. Here, a cost contribution is any essentially capital contributions other than investment contributions that are used to pay partnership expenses. Cost contributions can be viewed 2 ways. There are investment-related cost contributions that are worked into the actual cost of that investment, and then there are just essentially partnership-level cost contributions, to pay for the annual audit or pay the management fee or any other fund expenses, and those are often distributed or allocated to investments pro rata based on the amount of each investment. So taking a quick look here at the ILPA definition, it's essentially very similar. Annual rate of return, 8% compounded annually. Here, calculated daily. So the other definitions don't tell us when they're calculated. Calculated daily on capital contributions, made to fund the cost of the investment that is being disposed of. Each realized investment that has already been disposed of, that doesn't really get you anywhere if that prior investment made a profit. But here, if that prior investment was sold at a loss, LPs are made whole in this step because they're still going to get paid on those amounts. Let's go to the next slide here. We're going to talk a little bit about less common variations we see in waterfalls. Occasionally step 1 and step 2 are switched, where step 1 is a payment of all accrued but unpaid preferred return, followed by a return of capital. And here, there'll be a slightly higher preferred return since outstanding amounts are always going to be paid before capital is returned. So if there is a large accrual of outstanding but unpaid pref, and there's distributions that are coming from the fund, those amounts are going to be paid before capital is returned. So essentially, the capital contribution base is larger for longer. However, there's going to be less compounding. So the business folks need to pay a little attention to that to see how that changes the calculation. And then occasionally, you're going to see a preferred return based on an IRR, on an internal rate of return. And for example, here you would see a pref or a waterfall that says, first the investor is going to get a 10% return of the promotable proceeds in excess of the IRR hurdle. Here, that's 10%, and then over those amounts, there's a 70-30 split. And IRR oftentimes is defined other places in the LPA as the Excel XIRR function. That function specifically has a unique compounding feature that doesn't get modified, so people have kind of become comfortable with where they can land and understanding on the XIRR function. But it essentially uses daily compounding to arrive at an effective rate of return. In a lot of scenarios, a straight-up interest-based, we'll call it just a typical pref, and a IRR formulation have no differences. But in a small number of different scenarios, those differences can be pretty significant. And I'll show you a bit on the next slide here. So apologies for the wordiness of this slide, but if you've ever thought about how IRR formulations work, it can be a little complicated. So essentially, there are differences between these two formulations when an investment portfolio is calling new equity capital after some promotable distributions have already been sent back to LPs. And so when you apply that to a portfolio of assets, so if it's just one investment, if the fund is going to make one investment and then send all the capital back, it doesn't matter. If the fund makes 20 investments and then holds those for a long period of time and then sends capital back, it doesn't matter. But in certain types of funds, thinking credit funds or that are consistently calling capital and sending capital back, this becomes a bit of an issue. And it occurs because cash flows, according to IRR, are fungible. So in an IRR hurdle formulation, essentially prior period excess profits that get paid back to LPs later are reclassified to cover later capital outlays, as well as preferred return that is accrued, since the last distribution. So what you get here is an intended carry split is compromised retroactively, and that's because profits get reclassified as returned capital. Again, so for many single asset investments, this is not really an issue, but if there are, in some funds that have a lot of cash flow and they're calling capital while others, while also making distributions, the end result could be pretty significant. So, somebody should be asking those types of questions. Next slide. And then that brings us to this. When in doubt, ask for a model. The sponsors will have their waterfalls modeled out for you. And if they don't, they should put one together. And if they're using an internal rate of return model, you should ask for lots of different variations where all capital is returned back, or variations where capital is returned back while they're still making capital calls and making new investments. Oftentimes, we found that just asking for a model takes what looks like a very, very complicated waterfall structure and at least pins the sponsor down as to how they are going to be treating certain amounts when they come out. And with that, I'm going to turn it over to Shamim to talk a little bit about management fees.
Thanks, Trevor. Management fees are kind of, in principle, simple enough, but we find that the more time passes, the more we find nuance in management fee calculations and what their implications are for LPs. So going to the next slide, we'll cover first kind of the basic premise of management fee calculations, which are generally a percentage rate multiplied by a fee base. That percentage rate is, kind of straightforward enough. It's usually somewhere between 0.75% and 2%. More commonly, really somewhere in the neighborhood of 1.3 to 2%, with the exception of some perhaps non-core strategies at the outset. And then that rate changes once you get to a step-down date, assuming the LPA or the strategy that you're looking at contemplates a step-down. So the other side of that is the fee base, and we've included some sample fee bases here. So the first bullet point, describes essentially the fee base at the time of closing into a fund and prior to the end of the investment period. So generally, that is the entire commitment of the particular LP multiplied by the fee base. I'm sorry, multiplied by the percentage rate. After the step down, the fee base often shrinks. So one of two things will happen. Either the rate will shrink, or the fee base will shrink or change. And here we have sample language of a post step down fee base, which in this case contemplates capital contributions made by the LP to fund the acquisition cost of portfolio investments other than temporary investments, less an amount equal to the acquisition cost of portfolio investments other than temporary investments that have been realized in whole or in part, written off, or permanently written down. And what this essentially amounts to is capital that is still at risk, essentially, and it has not been brought to some disposition in full. Next slide, please. So when we think about management fees and step downs specifically, we're really thinking about arguably 2 or 3 periods in time. There's the management fee that is in place from the time that most LPs will close into a fund and the end of the investment period. This is arguably the period of time in which the sponsor is kind of most heavily engaged in deploying capital and managing capital, and thus that's kind of what we think of as the base rate going into the fund. Usually, a step down occurs at the end of the investment period, where new investments are not being actively originated and diligenced, and the fund is focused on managing investments that have already been made. Oftentimes, there's a second step down at the end of the fund term, prior to any extensions that may be permissible under the LPA, where really the sponsor is focused on disposition of assets. Step downs on the percentage rate side can take a number of different shapes. Oftentimes, you'll see just a simple reduction in the percentage rate. For example, if a strategy has a 1.5% management fee at the outset, you may see it drop to 1%, or some other number, or it may have a slightly more complicated step down structure. We recently reviewed a fund that had a step down and then a more gradual incremental percentage step down during that second window. and then obviously there will be a focus on the actual the fee base, which can also change during the two different step-down periods.
So,
yeah.
Question on the base, and unfortunately here I'm going to paraphrase a Meghan Trainor song with a bit of a dad joke where she talks about it's all about the base, which I think is really relevant in the preferred return and management fee context. So, what are we seeing about debt being included in management fee bases? Either, I mean, obviously, if the base is based on commitments, we're not that interested that whether debt is included or not, because it doesn't matter. But what about kind of in these step down periods where we're seeing some debt included in those amounts or in the base?
Well, yeah, I think generally speaking, we're not seeing a definitive answer one way or another, but we certainly like to ask the question. And, as we kind of covered earlier, when we're talking about, for example, a subline, we see that management fees are being charged, even if the capital may not be called. So, it's certainly one of these places where I think, between LPs and GPs, there's a desire to have your cake and eat it too. And, there's, I think, some sensible middle ground where, if you're getting the benefit of the preferred return on debt, then, perhaps the payment of the management fee on that amount is less offensive to our sensibilities.
Yeah, it's interesting, and we'll talk about this a bit in a moment with the increase in NAV facilities. But we often see where after the step down date, the base calculation will say and any remaining subline debt that's out there. And after a step down date or after the investment period, there's not a lot of base of capital, uncalled capital for sublines to be based on. Usually after the investment period is over, the fund is exhausted. Most of the it's uncalled capital. And so we could kind of get comfortable to say, well, all right, after the step down date, if you're going to charge on outstanding debt and you've got and it's only based on the subline, and someone has thought about it and said, well, the subline debt can't be outstanding for more than 180 days. Okay, then we can kind of get comfortable with that. But now that language is remaining in the management fee calculation base provisions, but now it isn't just limited to subline debt. It could also be based on NAV facilities. So then after all that, you're paying management fees on NAV debt too. So that's something just to be paying attention to.
Yeah, certainly something to be thinking about. So moving forward, after we think about the calculation of the management fees, we start looking at credits and offsets. And so, credits and offsets generally it covers fee income that's payable to the GP or the manager or some affiliate, which might include monitoring fees paid by the portfolio companies, advisory fees paid for services provided to the portfolio companies, board fees that might be payable to the sponsors, designees on the board, and so on. And so, as a rule of thumb, to the extent a fee is payable by an investment by a portfolio company to the GP or manager or one of their affiliates, because of the GP or manager's general investment management obligations, we insist that these fees are offset against the management fee dollar for dollar. Now, candidly, there's not it's not very often that we see some lesser amount than 100%, but we do see more and more exceptions to the offset principle, where, for example, certain services or certain personnel will not be included in the offset. And that's a place where we really push for as broad a net to be cast to catch as much of that kind of fee income in the offset. Offsets are generally sorry, I should clarify. So for one example, for example, that we are seeing more and more frequently is the use of expert networks by sponsors who have relationships with subject matter experts that they may draw into an investment for operational expertise or other kind of advisory services. And generally we take the position that if those experts are receiving employment or consulting income from the sponsor or elsewhere in the sponsor's kind of universe, that be included in the offset amount. However, if it's just a subject matter expert that is available to advise these companies, we take a slightly softer position on that. Then credits and offsets are generally paid in one of three ways. As a direct reimbursement or distribution to the LPs in the same amount payable by the LPs, as a credit to management fees payable to the GP or the investment manager by the fund at large as an expense, or at the end of the fund via the waterfall. And we should note that that last option through the waterfall is generally our least favorite approach for no other reason than it defers the point in time which capital is either credited to the LP or is returned to the LP directly.
Yeah, and I'll also add there that in that case the GP is getting paid a carry on offsettable credits that there was no amount, a management fee left to offset. So why are they getting paid a carry on these amounts that they should have been fully credited? And the landmine here is it's just going to say, the LP is going to say, return to the LPs pursuant to section 5.2, and section 5.2 is the waterfall. Right? It'll be very tricky. It'll be in there in a way that you won't even pay attention, but if you don't make that cross-reference, you won't realize that's what they're doing. Shamim, sorry to interrupt.
No, that's fine. So if we go to the next slide, we'll kind of flesh this out just a bit more, which is to say that, the most significant driver, in the context of the advice we give to clients is that, you want to ensure that the creditable amount or the offset amount is returned to you at the earliest point in time possible, that it's returned to you in full, and that you're not being charged fees on those amounts. And when we say that it's returned in full, what we mean is if there are LPs other than our client in a fund who are perhaps not paying the full freight management fee, but essentially get the benefit of the offset as though they were, that is something we seek to avoid. Other considerations here are when there is offsettable amounts, the value of which are not determined until some point in the future. We are mindful to advise clients that may cause an adverse outcome. So, for example, if an offsettable amount includes a convertible security like an option or a warrant, which gets valued at the end of the life of the fund, where ostensibly their value is the greatest, we are mindful that potentially changes the outcomes for the LPs. And the other item that we like to discuss with clients is whether the management fee, as it's being calculated, is based on the correct asset value for assets being managed by the sponsor. So generally, management fees are charged on a quarter ahead basis. But during that quarter, in particular, as you're getting to the end of the life of the fund, there may be, multiple dispositions of assets, which would mean that the management fee is being charged on a fee base that by the time you get to the end of the quarter is not reflective of the assets actually under management throughout that quarter. So we try to just be mindful that you're paying management fees on actual assets under management. And just in the next slide, we'll just talk briefly about catch-up payments and kind of other vehicles. So it's not new news to any of you that when an LP goes into a fund in a closing, after the initial closing, the LP is generally expected to catch up on management fee amounts payable since the initial closing. And in addition to that, there's generally an interest charge that's paid by those LPs. And we, as of late, have taken the position that while our capital wasn't being managed, we understand the catch-up payments on management fees, but understand less the basis for charging interest on those amounts. And we have been pressing sponsors more and more for waivers of those interest amounts, and have been seeing some increased success in doing so, depending on the size and timing of the LP's commitment, which, if a fund has been in fundraising mode for, 12 to 18 months, and depending on the size of an LP's expected commitment, that interest amount can be quite meaningful. Lastly, we'll just say that, the general principles that we've discussed here relate to what we kind of think of as core funds, core strategies. But in the context of co-invest vehicles, non-core strategies such as annex funds or warehousing vehicles, we generally expect that the LP won't be paying these full freight management fees, but rather some significantly lower rate. And when we look at that range earlier on, that kind of 0.75% to 2%, that bottom end of the range is really reflective of non-core strategies. Next slide. So jumping into NAV facilities very quickly, as we want to be mindful of everyone's time. It's not new news to any of you, but NAV facilities are essentially credit facilities secured by the net asset value of the fund. Unlike a subline facility, which is generally secured by the GP's ability to call capital to satisfy partnership expenses, which would include borrowing. NAV facilities include in their collateral package proceeds of investments, pledges on fund accounts, and equity interest in portfolio companies. The argument or the reason for using NAV facilities is many, but primarily they're used to create liquidity at the fund level, to be used for general fund purposes, expanding their investing capacity, creating liquidity, and so on and so forth. And this is usually after there's no longer meaningful uncalled capital to secure a subliner. Next slide. So our concerns, and this is not novel by any stretch. A quick online search of NAV facilities will reveal kind of a variety of sources that talk about the growing concern around NAV facilities, but are sometimes maybe less specific as to why. So the concern is that NAV facilities certainly create opportunity for enhancement of fund performance, but that enhancement comes with increased risk to capital commitments of the LPs. And depending on the NAV lender, an LP may have exposure to the same underlying asset through various strategies. For example, a single LP may be invested in a PE strategy which directly invests into an asset, but also be invested in a private credit strategy or more, which have exposure to the same asset, in the subline or through a NAV facility, and yet may have, direct exposure to the asset through a direct line of credit that the asset has. And so, there's opportunity for unexpected concentration in a common asset that is obscured through layers of commingled vehicles. So in the next slide, we'll just talk very briefly about some of the key terms to consider and things to ask about when we are looking at NAV facilities or the use of NAV facilities in a particular strategy. So first and foremost, we ask the question of fund counsel every time I think every time that we go through a diligence process, whether NAV facilities are included in the definition of borrowing broadly, and thereby are subject to the overall leverage caps of the fund and other limits on total days outstanding, et cetera. Second, and this is a place of, I think, more nuanced concern, we explore and ask about what rights the GP has to pledge collateral in connection with a NAV facility. And importantly, whether a GP's interest is part of the collateral package, because that puts the GP's stability as the fund's general partner potentially at risk. And then lastly, if a NAV facility is cross-collateralized across a number of funds, parallel funds or what have you, is it a condition of such borrowing that all of those funds enter into an intercreditor agreement allocating risk amongst the creditors? Because if an LP is invested in a particular fund and that fund is a part of a cross-collateral arrangement with others, failure in another fund should not necessarily impact the LP in a separate fund. So these are questions that we ask and we push on quite a bit to ensure that we have adequate visibility to what type of risk LPs are agreeing to at the early stages of the investment process.
Yeah, Shamim, I'd just add there that thinking about NAV facilities, the GP is increasing the risk profile, but they're not necessarily increasing the return profile. And so, in the past, those risks were on the GP, and now with a NAV facility, those risks get kind of shoved back onto the fund as a whole. So always something to consider about risk shifting when it comes to these things. So, yeah. Next slide. So here is the CLE information. You can scan the code there, the CR code. The attendance verification code is SS, as in Safe Barth Shaw. So SS 7841. SS is in Safe Barth Shaw 7841. Okay, thank you. Next slide. So just a couple of key takeaways from today's session. One is, read the LPA carefully. Again, for management fees and for preferred return, it really is all about the base and all about timing. So you want to be looking for those types of defined terms. Ask questions. If you don't know what something is supposed to mean, you should ask the other side. You should ask them to explain what they mean, because sometimes phrases or language in LPAs are a little confusing, and either that's intentional or unintentional. But in any event, have somebody explain it, tell you what it's supposed to mean, and if it needs to be clarified, just ask that it be clarified in the document. request models and examples. Again, ask questions, say, put this in an Excel spreadsheet for us. Let's have our commercial guys, our business guys take a look at it. I'm not saying that all lawyers are very good at Excel, so, you don't have to do that. And then, finally, nothing ventured, nothing gained, right? If you want to change in a term, ask for it. If you think that something is unfair or is giving one side a particular advantage, just call it out. The worst answer you could get back is no. So, our position is let's always ask for it and see what happens. Shamim, anything else?
No, looks like there's a couple of questions just that have been submitted. One of these questions, and maybe Trevor, you can answer this. So, Trevor, when we're talking about the preferred returns and the preferred return structure, is there any kind of ability to change in a side letter the kind of nature of the preferred return, or are those terms effectively fixed regardless of your kind of investment size?
Honestly, they're generally fixed. I mean, there's lots of potential at the margins, to make specific comments about timing. I think generally where we're finding a lot of luck is, when amounts are returned in those two scenarios we talked about earlier about amounts that are deemed returned and immediately recontributed, right? Because the pref will continue to run on the capital contributions in that distribution, and then the pref will start to run on the profit portion of that distribution that they have deemed distributed and recontributed. So we're always drilling down on that because maybe in some scenarios the language says may or shall, that the GP may determine to do this, and we've had a lot of luck getting may turned to shall. We've also had some luck getting really hard time limits in how long the GP can take a contribution before they have to either determine it's going to be used or send it back to you or have a pref run on it. So if the GP takes a capital contribution, they've held on to it for 60 days, they haven't put it to work, and there's nothing in the LPA that, there's LPA language that says, if we give this back to you, it's as though we never called it. What I want to see is a confirmation somewhere that says, if we hold this, if it's 90 days and we hold it for day 91, on day 91, the pref has accrued on that amount from day 1, not day 90. We're trying not to give anybody a 90-day loan, right? If you're going to use them, if you're going to call capital, put it to work. If you're not, you can hold on to it, but it better accrue the pref. So those are two spots that we've had some pretty decent negotiating history on with sponsors and had some pretty good luck.
And I guess I'll put this other one to myself, Trevor, which is, in terms of seeing success in negotiating these terms, my sense is that, regardless of the particular LP, they're all worth asking about. Are we seeing any trends kind of in terms of just kind of general market conditions that make, some of these asks more palatable or not?
Well, I mean, we've seen a lot of press lately on NAV facilities, in the New York Times and Axios and lots of different publications. So, I think sponsors know that LPs are starting to think about it and talk about it. And as a result, what used to just say in an LPA, one sentence, we can use a NAV facility, has now been built out a bit to say, we can use a NAV facility only after the subscription facility is exhausted, or we can use one only when the LPs or the LPAC have agreed to it. So, you should be making these asks. I mean, I think the best luck that most LPs have is when their commercial teams get involved and have a commercial conversation, with their counterparties at the fund that say, hey, we're not aligned here, right? Every dollar we give you should be, that you're charging management fee on should also be earning a pref. That should be equal at the same time. So getting the business guys involved early, educating them on kind of what these minefields are, if they exist. And again, these aren't in every partnership agreement, but you'd be surprised if you really start paying attention what you're seeing.
Yeah. Okay, and there's just one more question here about management fee discounts, and I'll just kind of answer this one generally. We see kind of management fee discounts or holidays in a few different instances. The first is, oftentimes you'll see kind of an early closing discount that buys down the management rate by agreeing to participate in an initial closing of a particular fund. And whether it's a discount or it's a holiday for some period of time where you're paying a reduced amount or not paying a management fee at all, that's certainly a kind of a feature that we see built into LPAs at different times and usually communicated via business channels fairly early on. We also see, aggregation of invested capital across a sponsor's various funds as being, a basis to reduce your overall management fee in a particular new fund that you're making an allocation into. And similarly, occasionally you'll see minor step downs based on or reductions in management fee rates based on the total amount of an investment in a given fund. And lastly, occasionally, depending on the due diligence process that you go through, you'll see some fee discounts, based on who you were working with through that process. I don't see any more questions in the chat, and if there are none, I think we can call it.
Yeah, feel free to email us if you have any questions. I think our contact information is up on this slide, so we're happy to answer any questions individually. And again, nothing ventured, nothing gained. You'll never get unless you ask. So thank you all for your time this afternoon, and appreciate you being here.
Thank you.